Hello, I'm Gina Florzak, Manager of Content Strategy and Publications with the CCM Institute. Welcome to today's webinar, Perspectives on Challenges in the Property Insurance Market, brought to you by the American Property Casualty Insurance Association, the National Association of Realtors, and the CCM Institute's Government Affairs Committee. We're happy to share this webinar with all of our members of the CCM Institute today. Joining us is Karen Collins, Vice President, Property and Environmental with the American Property Casualty Insurance Association. She will provide insights on recent losses and other trends resulting in the current hard market conditions for insurance, along with solutions that should help ease pressure on insurance affordability and availability. Please feel free to ask questions throughout using the Q&A tab. We'll be answering as many as we can after the presentation. And if you're experiencing any technical difficulties, please use a chat feature to ask for help. The recording and accompanying presentation will be emailed to all registered attendees. Karen, welcome, and thanks for joining us today. I'll turn the show on over to you.
Great, thank you. As mentioned, my name is Karen Collins, and I serve as Vice President of Property Environmental Policy Issues for APCIA for short. We are the primary national trade association for home, auto, and business insurers, and our association works to promote and protect the viability of private market competition for the benefit of consumers as well as insurers. We have a legacy that does go back 150 years, and our member companies do represent all sizes, structures, and regions to protect families, communities, and businesses across the U.S. as well as around the globe. So I appreciate the opportunity to share a commercial property insurance market update with you today, including many of the issues that our members are following closely. In short, the U.S. property insurance market is facing the hardest market cycle in a generation, which is impacting catastrophe-exposed regions across the U.S. I plan to share some insights today on recent losses and other trends that are driving this market pressure, but also highlight some of the solutions that we believe will help ease pressure. So let's start with some of the challenges. Since 2017, the U.S. has experienced significantly elevated natural catastrophe losses, with the most recent year since 2020 through 2022 reaching $287 billion. This has made it the highest losses in a 3-year period ever for U.S. insurers, adjusted for inflation. Just last year, the U.S. also recorded the highest proportion of global insured losses, 75%. And was actually the third consecutive year that the U.S. share topped over 70%, according to Aon. In this chart, which goes back 20 years, you can see the shaded light blue is a rolling 3-year total of annual insured losses here in the U.S., which underscores that cumulative impact of losses in recent years. Now, while many of the costliest insured losses often can stem from primary perils such as hurricanes and earthquakes, the insurance industry is increasingly feeling the effects of secondary perils such as wildfires, severe storms, flooding, drought, and snow and ice storms. Those are events that maybe happen on a more frequent basis, but aren't normally as large in the scale of losses. What you can see from this chart is that secondary perils are greatly contributing to the annual insured losses, with the chart on the right actually showing that secondary perils are actually now outpacing primary perils, and that's that darker gray line. The impact of these losses is creating significant stress on residential and commercial property insurance lines. Here, you can see the U.S. combined ratio for homeowners line of business for the last decade. And a homeowner's combined ratio essentially means that for every dollar that you collect, if you spend more than that dollar, then you're above a 100 combined ratio. And that is a loss. So what you see is that in the most recent years here, the countrywide combined ratio has climbed above 100 for 5 of the last 6 years, and is again expected to exceed 100 this year, which is exerting a lot of pressure on homeowners carriers. But if you're looking at commercial multi-peril lines, those losses have actually been even more significant in recent years, as the countrywide combined ratio has climbed above 100 for the last 8 years in a row. And data from S&P Global has projected an even higher year-end combined ratio result for the commercial multi-peril lines for this year, even beyond homeowners. This is a concern. When looking at the industry, we are also facing significant stress in other lines of business, such as auto lines, resulting in the industry experiencing its first combined ratio over 100 since 2017. Those are those bluish bars. And we also recorded as an industry a significant underwriting loss last year, the purple line. These industry-wide results across numerous lines of business are creating significant hard market challenges as insurers and also reinsurers work to adjust prices to better align with recent cost trends. To further demonstrate, you can see the profitability of the property casualty insurance industry has been extremely low and has worsened recently, as shown in the graph on the left, when comparing return on net worth calculated by the National Association of Insurance Commissioners against the rates for all other industry. In 2022, you see the deficient returns on insurance investments further worsened, with property casualty insurers almost 2/3 less profitable as measured by return on equity. So when considering interest rates have climbed, which provide alternative investment options, and the industry's lower profitability and thus return on investment, this has created financial headwinds for insurers and reinsurers to specifically attract enough new investment capital. So how did we get here? The insurance hard market that we're experiencing today is being driven by a wide variety of factors, such as historic rates of inflation, including higher material and labor costs, more communities that are in disaster-prone regions that are being impacted by more frequent natural catastrophes, and also the rising cost of capital, such as reinsurance, which is like insurance, but for insurance companies. But beyond economic inflation, there's also several other concerning factors that are amplifying loss costs in a handful of states, such as legal system abuse and claims fraud that we often might see in the aftermath of natural catastrophes. All of these are exerting pressure on residential and commercial property insurance rates, which are impacting the affordability of insurance. But insurers are also encountering increasing government interference in the form of both new laws that expand policy coverage, in the form of just changes to what is maybe required to be covered in a policy. And this results in overall increases in exposure for insurers. But also, companies are experiencing some regulatory constraints in some areas that simultaneously limit the ability of insurers to manage the growing exposure and costs. And these constraints and volatility are among the largest drivers, resulting in reduced availability of insurance challenges in several states. Last August, our organization, in conjunction with a few other trade associations, released a white paper entitled "It's Not Just the Weather: The Man-Made Issues Roiling Property Insurance Markets." And in this, we highlight some of those challenges from legal system abuse across the country as litigious environments combine with rampant lawsuit inflation to create, unfortunately, a windfall for some bad actors that, as I mentioned, seek to capitalize on insurance claims. In the paper, we chose to highlight 3 states that were experiencing some of the most significant issues resulting in severe market deterioration. And we highlighted Florida, Louisiana, and California. Just a quick couple of highlights on these states. So in Florida, prior to Hurricane Ian making landfall last year, the state had been dominating headlines due to the rapid decline of the property insurance market there. The state has been experiencing extensive abuse of their legal system and rampant fraudulent roof replacement schemes. There was an analysis conducted by the state that showed that Florida had been experiencing over 80% of the nation's insurance lawsuits, compared to less than only 6.5% of the overall U.S. population in that state. The resulting impact on the market was a wave of insolvencies before Hurricane Ian made landfall, even though the state hadn't experienced a landfalling hurricane since 2018. So instead, insurers who are facing mounting loss costs, they began to experience severe increases in their reinsurance costs, with limited appetite from reinsurers, ultimately causing a meltdown of the market last summer. Now, the state has since enacted numerous reforms to stabilize their market, and we are already beginning to see capital return to the market. Louisiana and several other coastal states that were nearby had begun to feel the spillover effects from Florida due to the sheer volume of insolvencies that occurred. In 2022, 7 P&C companies were placed into liquidation after 8 P&C companies were placed into liquidation the prior year, 2021. So 15 companies just in the last couple of years. But all the insolvencies weren't stemming from Florida. We had seen in Louisiana that their Department of Insurance noted of the 11 residential property insurers doing business in their state that had become financially insolvent between July of 2021 and September 2022, 6 had been because they didn't have adequate reinsurance to pay claims resulting from Hurricane Ida. So it's been a difficult market because it has also seen some of the harmful practices that proliferated in Florida, such as those abusive lawsuits that can result in assignment of benefits to contractors. But we have also begun to see some effort towards reforms in that state as lawmakers recognize the challenges in the marketplace and have begun to take some action for reforms this year. And also we anticipate some additional efforts in the coming year. The last state, California, has really been a perfect storm of record wildfire losses, severe inflation, and increasing exposure from wildfire risk. There's also been a lot of community growth in high-risk areas of the state, along with some of the mandated expansions of coverage benefits following some of these recent disasters. But in California, what is unique to the state is the regulatory environment has been among the most difficult to navigate for insurers, as rate filings, really to reflect these rising costs and overall risk, have been unfortunately very slow, which is creating a squeeze on the market. And so there's been a lot of attention this year by the state's insurance regulator and lawmakers to potentially enact reforms during the legislative session to modernize the state's regulatory process. Those, unfortunately, the clock ran out on the legislative session, but currently the insurance commissioner is working on reforms from a regulatory perspective. And so we're hopeful to see some improvement in the year ahead in California as well. So those are some of the state-specific pressures that often come up. But I'd like to illustrate some of the broader economic cost drivers that we are seeing across the entire U.S. In 2022, the U.S. inflation rate accelerated to a 41-year high of 8%, reaching a peak of 9% in June. Of concern, though, insurance claims inflation has actually been rising much faster and higher. Here, you can see a chart since the start of the pandemic and through June of this year that shows cumulative inflation trends for residential construction materials have increased by just over 35% for materials and 30% for trade services or labor. Now, this chart is specific to single-family residential construction, though the trends for multifamily residential construction are nearly identical, with just slightly higher peaks for labor in mid-2021 and 2022. Also on this chart, you see the cost to replace furnishings in a home are also very elevated, along with the cost for housing for those that may be out of their house and needing rental property or coverage while their property is being reconstructed or repaired. Another challenge the insurers are facing stems from land use policies across the U.S., as recent studies are suggesting these policies are exacerbating the effects of climate change. So, for example, there's been studies that highlight the extensive growth in coastal regions, as well as the wildland-urban interface, or WUI for short, have seen extensive growth in these decades. And that's actually a trend that further accelerated in the COVID-19 pandemic as more remote-based workers opted to relocate to more picturesque settings. Now, unfortunately, aside from some regions most recently, the growth in these areas, particularly in the WUI in our western states, that growth has largely occurred without risk reduction in place, such as the adoption or enforcement of wildfire-specific building codes or other defensible space measures. In inland states that face severe storms, there's been some research that has been noting that the largest driver of losses this year so far suggests that there's little evidence that climate change is actually impacting the key atmospheric ingredients that influence severe convective storms, like those that produce thunderstorms, hail, and tornadoes. Instead, reports are suggesting that over 80% of recent loss trends may actually be attributed to the growth in exposure, such as the inflation and increase of larger and more costly properties in high hazard areas, such as Texas and some of the other Sun Belt states. So again, these land use policies are really amplifying the overall exposure and overall cost that we're seeing in some of these loss events. But we do also know that there are increasing climate impacts occurring, and we do expect them to further intensify, making where we build and how we build a very significant factor. To give you a couple insights on some of those expected climate impacts, they will be intensifying for certain perils. And this shows kind of which ones have maybe the greatest confidence in the research currently. This scale from a company or modeler called Gallagher RE shows that more tropical cyclones or hurricanes are likely to reach Category 3 strength or higher in the coming years. Now, this is largely due to the increase in ocean temperatures that provide more fuel for storms to rapidly intensify. Warmer temperatures, heat is fuel, and that is going to create more energy to get to the point where larger storms do occur. A warmer atmosphere is also going to hold more moisture, resulting in heavier precipitation events that's likely to lead to increased inland flooding. So while sea level rise may impact more coastal flooding events, we are also seeing these excess rainfall events creating more flooding. At the same time, a warmer and drier climate is also going to have an adverse impact on vegetation, which is referred to as the growing vapor deficit. And that's going to enable fires to ignite more easily, spread more rapidly, and burn more intensely as they become more dry with that vegetation. So at a high level, these are some of the trends that the insurance industry is anticipating, though we're already seeing some of this translating to more frequent and severe natural catastrophe loss events. According to NOAA, and this is a chart from NOAA, 2022 became the 8th consecutive year in which the US experienced 10 or more separate billion-dollar weather and climate-related disasters. Now, that was led by Hurricane Ian last year, which became the second costliest insured natural disaster event ever globally, second only to Hurricane Katrina from 2005. In looking at event cost and event count, the smaller chart on the right that you see, you'll notice that 2022, along with many of these years since 2017, now rank as the most costly and active years, which is denoted by that light blue shading. And this is a chart that goes all the way back to 1980 and is adjusted forward for inflation. So a lot of loss activity and cost for insurers. During 2023, so this year, the first 8 months of the year, we have seen 23 separate billion-dollar weather and climate events. With approximately 4 months still left in the year, we have actually already surpassed the previous record of 2022. A record of 22 events that was seen in all of 2020. So we've already created a new record year for the number of events with 4 more months to go. Combined, we have seen these events produce more than $57 billion in damages. But for insured losses, what we're seeing from modelers such as Aon is that the natural catastrophes in the first half of this year in the US have already reached $40 billion in insured losses, making it the third costliest for first half on record. And it's also, again, reaching well above 70% of global insured losses so far this year. And this is, again, data just through June, prior to the losses that we've seen from, unfortunately, the Maui wildfires and other recent tropical storms and hurricanes. So a lot of losses. Let's take a quick look at what this is translating to in the market from a cost perspective. As a result of these trends, we are seeing significant double-digit premium increases in property lines. Now, this map, which is based on data from S&P Global and tracks approved rate filings across the US, provides a snapshot in time of what rate increases we're seeing. This specifically reflects the increase between January of 2022 and roughly the second quarter of this year. So roughly the last year and a half premium increases. We are also looking at some other sites, and one other website, Policy Genius, also has an estimated average increase for homeowner premiums based on surveys that they've done of recent quotes. And they're suggesting that countrywide, homeowners premiums are up roughly 21% this year. And that's kind of looking at May of this year versus May of last year, and may potentially be up nationally 35% since the beginning of 2021. So very significant double-digit increases. Again, much of this is simply the economics. Inflation, of course, is significantly up, in addition to the cost for capital, such as reinsurance in many of our catastrophe-prone regions. But let's take a look at those costs of capitals briefly. We have seen reinsurance rates between January through July of this year average 35% this year, which is the largest increase in risk-adjusted U.S. catastrophe reinsurance pricing in 17 years. And that's according to Guy Carpenter. But if you go all the way back to 2017, where we saw this kind of beginning of this upward trend of losses, the cumulative rate index for reinsurance has risen 97%. And as I mentioned, that is adding another layer of financial pressure for insurers in any state that faces catastrophes beyond the economic impacts. So let's talk commercial briefly. So the same economic inflation and reinsurance cost pressures are also impacting commercial property lines. Here you can see those trends over the last few years. Now, this data is from the Council of Insurance Agents and Brokers and shows commercial property rates have been steadily climbing from before the pandemic. Then increases did briefly slow down, but are now accelerating again at a much higher rate. The chart suggests commercial property rates climbed roughly between 12% between Q2 of last year and the first quarter of this year. Now, that's pretty consistent with data that we've seen from Ivan's monthly pricing index, which shows commercial property rates are accelerating with the August. So this August versus year over year last August have climbed roughly 10.5%. So as a side note, beyond economic inflation, natural disaster losses in the commercial space, we're also seeing increasing reports of shrinkage, which is impacting commercial property lines. When you see the headlines where there are increasing losses from organized retail theft, among other issues, these are compounding some of the other financial pressure. Another aspect that many overlook is also cyber risk for commercial property policies. And that's a significant concern. For premiums on cyber coverage, we have seen those surge in 2020 and 2021 during the height of the pandemic as more employees shifted to remote work. Significant attention, fortunately, has been focused on improving cyber hygiene for businesses and their employees to reduce risk of cyber attacks and hacking. And that has helped slow those rate increases, though there's also significant pressure that remains there. So the simple truth is the cost and the risk on the ground is growing, and insurers are facing a lot of financial pressure across the board. Now, the role of insurers is to help families and business manage risk through risk reduction strategies and options to financially transfer that risk. So companies are simply trying to ensure that the premiums they collect do, in fact, reflect the current cost to transfer risk. And this is what is resulting in the recent market pressure. Insurers may be needing to charge higher rates to address these cost pressures, but in some cases, if they're unable to raise adequate capital to cover potential catastrophic losses, this is where you see companies that might be implementing stricter underwriting or even needing to rebalance their risk concentration in certain disaster-prone regions. We know this is difficult. It's impacting all other property development stakeholders, including realtors, though most importantly, consumers. Insurance companies don't want to retrench in the market, but they do need to be able to adequately manage risk exposure in order to have the financial strength to deliver on those promises they make to policyholders when disaster strikes. Now, media coverage often portrays this as regions maybe becoming uninsurable due to climate change. Insurers actually disagree that that is not really the case. It lacks the nuance. As long as insurers can collect the premiums to reflect the cost of risk, coverage should remain available. But that cost of transfer risk has surged and is making some regions so unaffordable that that becomes a concern for consumers that may be residing in those regions. So insurance affordability and availability is having a real impact. And we understand that there's challenges, but this is where we're fighting for solutions, and we need your help. We want to work together to bend the loss curve down. With climate change impact showing no signs of easing, our industry and members have placed substantial focus on mitigating future loss costs to help keep families and communities safe and ensure that the private insurance market remains well positioned to provide that financial protection against all of these events. So let's talk about some of those solutions. In March of this year, we did publish a white paper on the current hard market conditions. Now, in that paper, we highlighted the research of the Insurance Institute for Business and Home Safety, or IBHS for short. Along with their research, we also specifically highlighted a couple examples of mitigation in action, because we firmly believe stronger homes and businesses built for or adapted for the local risk should result in a meaningful decrease in future expected losses. So really, to ease that pressure on property insurance markets, pre-disaster mitigation provides the most critical tool to reduce exposure and future losses. And that in turn is what will positively impact insurance costs and availability. So let me walk through some of those examples briefly. Hurricane Ian gave us one of the best examples as a use case on the performance of newer building codes. Now, this is because where Ian made landfall is essentially the same location that Hurricane Charlie came ashore in 2004, which was also a Category 4. And you can see that path in the chart on the left. So following 20 years of homes built or rebuilt to stronger codes, the cost savings from loss avoidance was undeniable for the structures that were better able to withstand the effects of the current storm, Hurricane Ian. And you can see that the photo on the right is one example of where 18 homes built before 1981 were completely wiped out, but a home built in 2020 appears almost unscathed. Now, what's interesting of this photo is it shares some strong similarities to the quote-unquote red roof house in Maui, which survived the Lahaina wildfire while all others were destroyed. For those that are not familiar, the red roof house, or miracle house as others have called it, is on the left from media coverage. Now, this is a historic home that had a restoration project completed in 2022. Now, according to the owners, they made these changes to address termite issues, not intentionally for wildfire. So they removed 5 layers of asphalt on the roof, installed a commercial grade corrugated metal roof that included an air pocket to allow heat to dissipate. And at the ground level, they removed all vegetation along the house's drip line and added a stone buffer. Again, wasn't to thwart fires, but termites. But while these strategies were not intended for wildfire mitigation, they were actually very consistent with the work and research of IBHS to create an ignition-resistant zone around the home. And the result is that the only damage that that property sustained was a warped PVC pipe on the wall and a little bit of blistered paint from the intense heat on a wall near their kitchen. Otherwise, the home survived. In the chart on the right, you can see a new program from the Insurance Institute for Building Home Safety called Wildfire Prepared. And the key elements for this program, which is to reduce the threat of wildfire, includes fire-resistant materials, a Class A fire-rated roof and building features, and defensible space, which must be established and maintained by eliminating all flammable materials around the home, at least within the first 5 minutes. Now, what's increasingly clear from the research in these examples is that mitigation can result in a meaningful decrease in losses, which when done at scale, should positively impact the affordability of insurance for consumers. So we say at scale, we want to show examples of mitigation done on a community-wide basis. Here's a great illustration of community scale resilience following Hurricane Ian. If you're not familiar with Babcock Ranch, this was also highlighted in the media. It's a 2,000 home community built 12 miles northeast of Fort Myers, Florida, and only 35 miles as the crow flies from where Ian made landfall in Cayo Costa. The community features a variety of neighborhoods from different home builders, and prices generally range from the 300s to over 2 million, including condos, townhouses, single-family homes. It was touted as the first fully sustainable and quote-unquote hurricane-proof community. Their developer set out to design a community that protects natural habitats and also works together with the surrounding environment. So their key design features included structural hardening. All the buildings are designed to withstand 160 mile per hour winds, exceeding recent Florida codes, which require hurricane force winds up to 145 miles per hour. The community also had flood control measures. It's located 30 miles inland, and homes are built 25 to 30 feet above sea level to avoid that storm surge. They have retaining ponds and native landscaping to control stormwater and prevent flooding. while their roads are designed to flood during storms instead of the homes flooding. And lastly, their infrastructure. Their community is powered by 700,000 solar panels and utility lines that run underground to help prevent power outages during these storms. So what does all that translate to? In the aftermath of Hurricane Ian, the community received considerable attention in the media because they never lost power, they never had any flooding, and they sustained minimal damage. Literally, in the days after Hurricane Ian hit Southwest Florida, there were inspectors from FEMA that visited Babcock Ranch in Charlotte and Lee counties, which were arguably the two most impacted by that Category 4 storm. They saw very little damage at that community, and initially determining that the storm must have inexplicably missed that development. You had people walking their dogs, going for coffee, while just miles away was absolute devastation. That is the impact of mitigation. Another example, in the paper, we also highlighted Paradise, California, as a great example of ongoing efforts towards community scale resilience. Sadly, in November 2018, the Camp Fire destroyed the entire town of Paradise, located roughly 90 miles north of Sacramento, California. The fire destroyed more than 18,000 homes and structures and displaced many of the town's 26,000 plus residents. And it tragically resulted in 85 deaths, becoming California's deadliest wildfire in history. Working together with IBHS to achieve greater wildfire resilience in the aftermath of that loss, the town of Paradise is rebuilding the community to a higher building and defensible space standard. In June, a home in Paradise last year became the first in the country to receive the new wildfire prepared home designation. Additionally, Paradise became the first community to incorporate that wildfire prepared home framework into a local ordinance, which requires, as of July of last year, all new homes built in the town to achieve and also maintain that designation. And in addition, for homes rebuilt prior to July of that year, IBHS is also working with FEMA on a grant program to help aid homeowners in retrofitting their homes to meet that designation. So again, those are just examples of mitigation efforts that the insurance industry is leaning into. But we're only one part of the broader property development industry. And as I mentioned, we need the help of other stakeholders. We recognize land use policies in high-risk regions, such as Western states, are often well-intentioned to provide increased affordable housing in lower-cost regions. However, they're also inadvertently resulting in increased risk exposure and thus higher loss costs for insurers to bear, which impacts all consumers. So we're encouraging policymakers to re-examine land use policies and also the building codes adopted in these regions so that we do a better job of addressing where and how communities will be built so they can withstand those risks that they might face. Now, we know builders can play a tremendous role in helping to inform those codes and standards and in educating consumers of the value of resilience. There may be a higher cost initially to build to more resilient standards, but there's also return on investment from that cost that needs to be emphasized for consumers. This might include increased property resale values, improving insurability, and avoided loss costs such as insurance deductibles or other loss-related expenses that may occur following a disaster. Similarly, the financial services industry can play a significant role through how mortgages and real estate transactions are handled. Realtors and mortgage providers can lean into climate-related resilience when a property changes ownership through increased hazard and risk disclosures, potential enforcement of critical risk reduction actions, and perhaps most importantly, providing funding for mitigation by incorporating that possibly into a 20 to 30-year mortgage, or potentially providing more points or better rates. This is actually currently being explored at the federal level with growing attention to provide incentives for resilience, similar to the incentives that we've seen provided for energy efficiency. Also in the wildfire space, that change of ownership can also present a significant opportunity to enforce landscape changes to establish defensible space. There's often resistance that we hear about from current homeowners to move vegetation, perhaps because of emotional attachments. For example, if someone has a favorite rose bush that was planted years ago, maybe by a family member that's no longer with them, and that's right in front of that home, this is where there can be resistance to certain changes. But what happens with a change in property ownership is that barrier is actually removed. And realtors, much like contractors, can also provide critical consumer advice during this period to help really educate on the holistic value of resilience and making those changes. And then, of course, there are insurers. We are really at the end of this development chain, and our role is to similarly help educate on risk reduction as well as the risk transfer strategies that we can provide. Now, we achieve this on the most frequent recurring time frame than others through our annual policy renewals, or when a new policy, of course, is established through the underwriting of risk. And this often is where we might require certain mitigation actions be done as a condition of coverage, as well as reinforcing some of those through pricing mechanisms, which can help provide some of the strongest signals of where risk may be increasing or has been reduced. We've had some conversations with others within the property development industry and with the banking community in particular. They have shared a recognition that the inflation cost pressures are likely going to continue to climb for reconstruction costs. And that's particularly true for hazard-prone regions, which is going to further impact affordability over time. But in the banking community, they note that while affordability may become a growing concern, there's also inability to sell at a profit now. So if these risk signals are accurate and available, such as through insurance or otherwise, this is actually beneficial to the overall housing market versus suppressing any of these signals, which over time can create larger unintended consequences on property markets. So for realtors specifically, there is benefit when your property values remain stable or are improved, and that can have a direct impact also on your commissions. So we share all of this because we all of the organizations within this property development industry have a stake in these challenges. And where we have found the greatest alignment is the need for communication of risk along with ways that we can reduce the risk itself. So as insurers, we recognize that we can support this in our various opportunities, certainly when properties are being reconstructed. And we want to work more closely with builders in addressing resilience at new construction as well as reconstruction, and also have builders continue to work with the broader financial services industry to address resilience for existing homes through retrofits and defensible space. So one last slide before I close, I want to share some very specific ways that we within the property development industry can achieve this. There are grants. States or local communities can establish resilience grants to help property owners. Programs might include a cost share match for a property owner or through public-private partnerships. There are low interest loans. States or local communities can establish revolving funds that can help provide low interest loans for resilience projects. Alternatives, I mentioned, we could incorporate funding for mitigation into mortgage costs that allow us to spread that cost over 20 to 30 years. There could be opportunities to waive or reduce fees. Communities might consider providing a rebate or waiving or reducing building permit fees or the cost of designation program inspections for properties that achieve a qualified resilience designation. For example, IBHS, as I mentioned, has wildfire prepared home. And in coastal states, they also have a program called IBHS Fortified. Then there are tax credits. States or local communities can provide a variety of tax credits, such as income tax credits for costs to retrofit homes or businesses, sales tax credits for materials purchased to retrofit, or even property tax credits for those that achieve and maintain a resilience designation. There's a lot of attention with tax credits, again, for resilience, similar to that done for energy efficiency. So you'll probably see a lot more attention here. And then lastly, insurance incentives. States can encourage insurers to provide premium credits for resilience actions. And we actually are doing this in many of our coastal states. That Fortified program from IBHS is a very well-established program that can result in significant premium savings in coastal states. But we're also seeing a push for this for premium credits in our wildfire states, and we're trying to ramp that up as we have the ability to expand those programs. So In conclusion, that's a lot of information, but I want you to, the biggest takeaway that I want you to have from all of this is that there are challenges facing insurance markets, but those challenges go well beyond the increasing natural catastrophes that we're seeing from climate change. The demand for insurance has never been higher, but the amount of capital available to insurers has also contracted with the increasing record losses, while other cost drivers are continuing to climb. And this is going to continue to put upward pressure on insurance premiums that are resulting in the actions that insurers are taking to ensure they have sufficient capital to fulfill society's increasing coverage needs. Insurance, we are simply the cost of expected losses. So the more that we can work together to mitigate homes and properties to help bend that loss curve down, this is what will have the best positive impact on the cost of insurance in the long run. So I'm going to close and open up for questions here. I will just note that in the last of our slides is some information on wildfire. If folks would like to learn more, we have several white papers on natural catastrophe perils. Some of them were in the earlier slides. And they all include emphasis on the benefits of mitigation. This is one that is a 3-part white paper series on wildfire specifically, which was released in November of last year. And this examines the increase in risk and costs, as well as the challenges insurers face in managing the peril of wildfire. And the third paper really dives deep into the latest on mitigation. So with that, I will welcome your questions for the duration of the time that we have. And again, I do thank you for the opportunity to present these insights and perspectives on the challenges.
Excellent. Karen, thank you. Thank you. We have a couple questions. The first one is, why is Arizona insurance increase so high? Do you have any insight on that?
Are you asking about increases or ultimate costs? I don't have the chart for the ultimate cost. I think insurance in Arizona has been relatively lower compared to most other states. So it may be that they just have companies that are needing to adjust to more recent inflation if they haven't taken those increases, or it could be that individual companies are experiencing greater exposure change. I know that Arizona has been one of the leading states for growth in population. And that, as I mentioned, those land use policies can substantially expand the exposure of companies. I know that Arizona also faces risk from several different types of catastrophic perils. It's increasingly experiencing similar wildfire risk, as well as there is flooding related issues that can happen, particularly with some of the severe rainfall events that come through from atmospheric rivers and storms, as well as summer monsoon patterns that can come through. So there's, I think, quite a bit of exposure from natural disasters, along with growth in population. And that is being experienced, I think, more on the property side. There's also, I think, cost of insurance with that. Growth in population and congestion with traffic could also be pressuring maybe some of the auto challenges and cost pressures there as well. So those would, without pulling my specific notes up, would probably be what is maybe driving more of the Arizona related increases recently.
Thank you. We do have another question that came through. At the federal level, what should we, as in brokers, advocate for as the most effective legislation to mitigate commercial insurance costs?
So we have been working very closely with federal policymakers. There's actually going to be, I believe, tomorrow, a very significant report on wildfire that is going to be released following a year of discussion within a commission that was established to address the challenges of wildfire mitigation and managing that at the both landscape level as well as within the built environment, so the communities that we live in. And there's going to be a tremendous number of recommendations for policies that Congress should be considering. And many of these are specific to wildfire, but have similar application to other natural disaster perils. Again, there's a shift from reactive to proactive. We can continue to keep paying the losses that are happening, but we can bend that loss curve down through mitigation. And so if we can shift more of our attention and investment to mitigation, we can, on the long term, really bend that loss curve down and improve affordability for all. How you get there, there's a lot of need for disclosure of risk. And I think this is a big area that the realtor industry, mortgage brokers, et cetera, can lean into. And how do you inform those who are purchasing property, whether it's a new development or also existing change of ownership. And so there's going to be a lot of attention on that. There's the funding of how do you achieve that? How do you adapt existing properties for resilience? And where does that funding come from? And this is where I've highlighted some of those, and there's going to be increasing attention on ways that they can do that at the federal level as well. In the wildfire space, a lot of this land use policy, because the Western states still have a lot of open space and there's a lot of growth there. But those land use policies, again, are going to be so critical with where do you build? And if so, how do you build? And so there's increasing attention at the federal level to help maybe incentivize states, because that is a state's decision or even a local ordinance on land use policies. And so there is potential for the federal government to maybe support states in developing their own hazard models so that they understand with hazard maps where that risk is, so they can inform those land use policies and the codes that maybe should be adopted in those areas. And so as realtors, understanding these dynamics and how they impact your stake in the broader property development industry, all of these work together and the need to be more resilient. And so there's going to be a lot of opportunity at the federal level to really lean into these resilience priorities. And there's just a number of them, but these are just maybe some quick examples.
Yeah. Thank you. You talked about at the state level. We do have some commentary coming through regarding Texas. Can you talk about the increases that have happened in Texas for commercial properties over the past few years?
Yes, so Texas has been probably one of the biggest states from a growth of population, new communities perspective. It's a huge state, and it's got a lot of space to build, and we've seen that growth in many ways and over many years. The challenge is that Texas faces some of the greatest risk from not just one or two, but many types of natural disasters. Hurricanes, clearly along their coast. They have exposure to wildfires, but they are also very impacted by severe convective storms or severe storms. And when I say that, if you're not familiar, that is storms that produce thunderstorms that can result in hail or tornadoes. The state has also experienced recent severe losses from winter freeze events that stretch deeper south that have not maybe been typically seen in years past. And so what we have seen in Texas, almost more than any other state, if you were to go to NOAA's website and pull up the types of losses that they've seen in recent years, their trajectory is way high on just the volume of loss events. Some can be large events like Hurricane Harvey that made landfall in Texas and created substantial flooding, but it's often the other smaller events that on a cumulative basis add up. It's kind of the death by 1,000 cuts analogy. The severe storms and the winter storms with the freeze and the wildfires collectively have made the costs to rebuild in Texas so significant, and companies are needing to replenish that capital that they are deploying to help pay for those reconstruction efforts, as well as replacement of contents within those homes. So again, insurance is simply the cost of claims, and this is a state that is experiencing more claim costs from natural disasters than most other states across the U.S.
Excellent. Karen, thank you. I think that's all the questions that we have for you this afternoon. Thank you for sharing your expertise with us today. And thank you to everyone with us for attending. As a reminder, the webinar recording and accompanying presentation will be emailed to all registered attendees. In the presentation, Karen shared several resources to learn more, including an overview of hard market conditions from earlier this year. These and other links will be shared in the post-webinar email, so you can look forward to receiving that very soon. All right, again, Karen, thank you. Thank you to everyone, and have a great rest of your day.